Welcome back. Here with Money, 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 and this week we are discussing home loans, how to go about building or buying that dream house. So, Rakesh, now I want to talk about the most important aspect. Fixed versus floating, and now we've seen a regulation change where MCLR, this marginal cost of funding, that's the new norm as to how banks are benchmarking their rates. So what is happening in the market, and how should I ensure that I get the best and the smartest home loan where I have to pay the least?
Yeah, so one really needs to evaluate what is the interest life cycle which we are going through. So if the interest rates are coming down, you can expect that the interest rates will come down in the next year or 2 years. But if the interest rates are going up, in that scenario, your repayment can really get impacted if you have taken a floating rate of interest. So one needs to really look at their appetite in terms of whether they want a consistent repayment, which they need to do, and they are more happy with that, then they can take a fixed rate loans. But if you want to benefit from the downward interest rate cycle, floating is an option. The third option is you can take a semi-fixed.
Yeah.
So you can take a fixed for the first 2 years, first 3 years, and then move to the floating.
So now let me drill down even further. Typically, over the repayment life of a loan, which is about 25 years or so, or 30 years, I'm guessing, there will be several cycles. There will be the interest rate up cycles and down cycles.
Yes.
So therefore, how do you ride these cycles? And in the current environment, when we're looking at interest rates largely going down over the next 1.5 years, how should one go about structuring their loan?
You have to see what really suits you. What is, whether you want to have a fixed repayment on a monthly basis for your EMI, or you want to take advantage, or you are ready to pay a higher rate of interest when the interest rate goes up. So it all depends on the individual buyer or a borrower, what kind of risk appetite he has.
So explain the semi-fixed product a little more clearly to us and how it works, its benefits, and the concerns that one should remember.
So semi-fixed is when you start and you take a home loan, the first year or two is the most difficult because your EMI starts kicking in and there's a monthly repayment. So if you have a consistency in the first 2 years of repayment, and
so
once you
fixed in the first 2 years.
First 2 years, and then you can move to the floating. So by then your repayment and your cash flows has really matched up. So post that, you can move to the floating. So if the environment is that the interest rates are coming down, then you can, from a fixed, you can move to the floating.
And how frequently are floating rates regigged and pegged towards market rates? How frequently will my EMIs change?
So it all depends whenever the base rates or the MCLR rates, whenever it gets reviewed, the interest rates of the customer will get reviewed.
So should we expect changes on a quarterly basis, or could it be even earlier or monthly for that matter?
It can happen.
So it's absolutely floating in that sense.
Yes.
It's a very dynamically sort of priced product.
Yes.
Okay, so Gaurav, now fixed versus floating in the current environment. Now we know rates are going down, at least assuming for the next 1.5 years. How would you advise someone to structure?
For anybody who's looking at repaying a loan within 3 to 5 years, we would say fixed.
Okay.
Irrespective of situation, because then you're sure this is what we are going to have. But the moment somebody's saying, I'm looking at...
You have to have great cash flows to take on a big home loan in a city like Mumbai or Delhi and, say that I'm going to pay it off in 5 years. But yes, great for those who have that.
What happens is, lot many times people are selling off first loan.
Absolutely.
And hence they have a large chunk which is going to take care of the down payment. So the actual loan amount is very small and they can afford. So that's... If it's going to be a longer tenure, go for floater, because it's going to change. It's one thing for me and for him to really say what is in interest of the client, and that's the real good thing. Most people tend to ignore this of switching, or actually being aware, kind of coordinating with the lender, saying that, hey, my EMI is not changed, or is there something? They kind of ignore, and moment that starts happening, then you have no idea. So then you put them on autopilot and say, be in floater. If it goes up, so be it. If it comes down, so be it. Because it's not that after 4 or 5 years, if rate of interest falls and if there is no change, whatever, they're going to really call up. Some of them do, but it's not that all of it. It just goes on to
But thumb rule is, if it's a really long loan, 20 years, go on floating. If it's a short repayment and you're perhaps only switching to pay off an existing loan, then go for fixed.
Also, I don't think we now have anybody offering fixed for life. I guess most of them are offering for a fixed. Once upon a time, we used to have that fixed for life. I guess it's been years that people have stopped fixed for life. So in any case, even if you're in fixed regime, I think every 3 years or 4 years, lender has an option of changing that. So it's not really fixed for life kind of situation.
So Rakesh, Gaurav also mentioned an important point there, switching.
Yeah.
A lot of people would like to shop around for better, products or, better interest rates for that matter. Do explain to us the regulations that go with it, and when is it advisable to switch and when is it avoidable to switch?
So today, as per the regulation, there are no foreclosure charges for an individual customer. So he can move his loan from one institution to the other. But there is a process. The process of shifting from one institution to the other is a cumbersome process. So unless your benefit is substantial, one doesn't really wants to move out from one institution to the other. So one should really weigh what is the benefit, risk reward, what is the benefit he really gets, and then decide whether he wants to continue with the same existing lender or wants to move to the new one.
Also, Surabhi, there could be sometimes service charge, administration charge or whatever. Now, that's charge on the entire principal amount. So when I'm switching from one institution to another, the new institution is going to levy that. Now, if that is...
It won't consider the amount of principal that you've actually repaid.
So it will. Yeah. So for example, my outstanding is 20 lakhs and I'm shifting 20 lakhs. Now the service fee or administrative fee, it could be flat now, but if it's a percentage, say 0.5% or 0.25%, I'm already paying that. And to that extent, my interest rate is going up.
Sure.
So, you have to factor in those expenses. Switching costs should also be factored in before switching in.
Okay. Another aspect when we're speaking of structuring loans, and you mentioned this earlier, whether it's an individual borrower who's taking the loan or whether it's two borrowers. I mean, if there's a couple that's taking the loan together. In that case, how do you go about structuring? Let's assume that we're talking about an 80 lakh or a 70 lakh rupee loan. There are two earning members and they both want to take the loan together. How do you go about structuring? Is it advisable, first of all, to take a joint loan?
It is. Exactly prior to union budget, as a planner, I would be a little more careful because I may not want both of them to take it if one of them can afford, because there was a wealth tax issue. So at later date, if we feel the client has potential to pick up second one, then we'll do one on husband's name with wife as a beneficiary and later second. But now that wealth tax is gone, if that's not, and I hope that doesn't come back, in that case, what we are looking at is a situation whereby we are saying that yes, both of you will take it, then it becomes like a joint income and the EMI on that and the joint list of assets and the employability. For us as a planner, the employability, the work experience, the qualifications are very important, because if they were to lose that, how likely or soon they are going to get another opportunity. If somebody is in business, then how many years the person has been in that particular business. These are parameters that will decide that they can sail through the loan without much of difficulty.
Okay. And as a lender, Rakesh, how do you look at the prospects of an individual borrower as opposed to a joint loan?
No, a joint loan will always be better because the family can afford a better house. So there are two cash flows coming in and they can afford a better home. So I think we would prefer that way, if the family income is coming in and they can buy a house which is really meets their requirement.
All right, so we'll take a quick break on that note. On the other side, of course, the all-important aspect of taxation when you're looking at buying a house and taking that home loan. We'll get you the details.